Hey everybody, how are you? John Napolitano here with you at Top Trading Pros. I wanted to make this video today to talk a little bit about the Volatility Index and certain VIX products that you can potentially trade in the options market. Now, I'm not a fan of trading this stuff, and I'll be honest with you. The reason being is because volatility products tend to be a little bit challenging to trade from a expense standpoint. They can be expensive, especially at the times when you actually want to trade them. The spreads tend to be a little bit crazy sometimes, but they are useful for hedging on occasion, and you can potentially speculate on them. Again, it's not necessarily my cup of tea or the core things that I trade. For those of you who know me, I do mostly basket trading. I do swing trading, and my bread and butter is analyzing the market from the top down and coming up with the optimal basket, both on the long and the short side. That being said, there is a place from time to time to either trade the VIX products or to potentially use it for a hedging purpose. So without further ado, I'm going to jump into it. And without giving you an opinion one way or another, what I really want to do is just kind of show you basically what the different situations are and some of the things that you can look at. So the first thing I want to take you to is just a quick chart of the VIX. Now, just by looking at this, just recently from April on to July, you can see here that the VIX really is not that elevated, basically for the last several months, although it's had a few minor spikes from here to there. And actually, we're in the middle of a little bit of a spike now, because at the time of this recording, we just had some massive sector rotation. Today, for instance, the NASDAQ was down over 2%, and the VIX did spike based on that, because there are people, and when I say people, there are institutions out there hedging their bets. The whole definition of the VIX is basically the put-call ratio of the S&P 500. So how it's really calculated and the math behind it is a little bit beyond my pay grade. But to make a long story short, the VIX basically measures fear, because it essentially measures how many puts are being bought versus how many calls are being bought. So the more puts that are obviously being purchased, the VIX will tend to spike. So just by looking at this, you can see that there are times in history when you go back here last year, and when you go here, this was back in April during the whole Iran and Israel saga that was going on. There was some insurance buying going on. And now you have a minor spike going on right now, just due to the sector rotation that we had the last couple of days. So the question is, how do I trade this, or how do I potentially profit from it? So let's talk a little bit about if you wanted to do a swing trade. Now, when you're looking to do a swing trade, I'm going to jump into the option chain here. There are a couple of things available for you to look at. I'll start first with the actual simple VIX. The VIX is here. Just type in VIX on Thinkorswim, and you'll get the typical European-style option, which is basically an option on the futures contract. So I want to be very clear about that. It's an option on a future contract, which basically means it is a European-style option, which means it is cash settled. So everything you see in front of you, the bids and the offers and everything else, is cash settled. You will never get assigned the VIX, because the VIX is a product, obviously. So that is just something to keep in mind. Okay, now there are other products out there that are American style options, which I will get into momentarily. But let's start with this. So right now the VIX is at 1448. And as you can see, if you want to buy an at the money call option for July 24th, which is just 6 days out, it's going to cost you between 70 cents and $1.98. Now, a lot of these actually traded today, about 1,200 different contracts traded today. But here's the thing. If you look at the difference in spread, 70 cents doesn't sound like a lot of money, but let's talk about $70 versus almost $200. You're talking about $100 spread. Let's just think about that for a second. That is a ridiculous amount of difference between the bid and the offer. So this is why I have a little bit of an issue with volatility products. So when you decide to buy a call option or a put option, by the way, on this, you have to keep in mind that you are crossing a pretty extreme spread. So that's problem number one, I would like to call it. Now, obviously, there are some things you can do. If you're in not a hurry, let's say you just want to go long the VIX because you feel like there might be a spike in volatility in the next couple of days or next couple of weeks. Let's say we're in earnings season, which we currently are. You might feel that due to the earnings season and due to the sector rotation that's occurring, you might get a spike in the VIX. So if that's the bet you're going to take and you want to hold the VIX for, let's say, a prolonged period of time, and what I mean by that, I'm talking about maybe a week or so, you can go ahead and leave a limit order. And if you go ahead and leave a limit order, I mean, the fact that 1,200 contracts traded, you'll get filled at some point. So I think patience is the key when trading this particular product, because basically, if you just cross the spread, you're probably going to overpay. Think about that. If, let's say, just to keep the math simple, it's a $2 option. And currently the VIX is at 1448. So your break even in the next 6 days, think about this for a second, has to be at least 1648 for you to break even if you were to cross the spread and pay, let's say, $2 for that option contract. So keep in mind, you have to be fast when it comes to this stuff too, because the VIX does tend to spike. Let's go back real quick and look at the chart. You can see that if you manage to cover your contract, if you buy your contract and let's say it does manage to spike, you might get lucky and be able to close out that contract and for a little bit of a profit. But keep in mind too that these spreads are very wide right now when the VIX is subdued. I could only imagine what the VIX would be like if the VIX, what the spread would be like if basically the VIX was elevated. If the VIX was elevated, the spreads would even they'd go out even further. Just keep in mind, the market makers do not make it easy for you. So it's not the most efficient thing in the world to trade, and I kind of want to point that out. Now, when you have a situation, I'm going to go back now and show you a little bit here. You can look here at the implied volatility on this thing. It is clearly very high. It's 120%. For the at-the-money option, it's 69%. So if you think about it, the S&P 500 right now, the implied volatility is somewhere around 12%. So this particular product, the VIX product, the European-style option, has a significant amount of implied volatility attached to it. So that means automatically that you're overpaying for this option. Now, another thing you could consider doing is a credit strategy where you do some sort of a credit spread and you basically just wait for the VIX to collapse. In my personal humble opinion, that's probably the best way to trade something like this, because if you think about it, what you're doing then is you're waiting for the VIX to contract. And if you look, let me go back here again, just to show you the chart again, the best way to play something like this is to play a contraction, not an expansion. Because if you look, the VIX spends a lot of time contracting and not that much time expanding. You tend to get a 1 or 2 day spike versus, if you look here, let me zoom in so you guys can see. If you look here, you can see that it when it does contract, it contracts for several weeks. So the best way to play the VIX is on the short side, where you're essentially doing a credit spread and you're just allowing the premium to melt away. That would be a decent way to play it. Now, intraday VIX you can trade, but again, you're not going to make as much as you think because the spreads are fairly challenging. So that's product number one. The other one I want to cover is something called a leveraged ETF, which I'll get to next. Let me go to here again. And what I will do now is, let's see if it's UVXY. So if you look here, this is called the ProShares Ultra short-term VIX, and it's 2 times. So basically, what this essentially does is it mimics the VIX times 2. So this is a leveraged ETF. So what leveraged ETFs do is they use the futures market to get that 2 to 1 or 3 to 1 or 1.5 to 1 leverage. And what they essentially do is give you the imitation of if the VIX moved once. In other words, if the VIX moves 1%, this should theoretically move 2%, and so on and so forth. Now, with that leverage comes a lot of volatility. And as you can see, it did kind of spike up today. So I'm going to go ahead and I'm going to show you the bigger chart here. And we'll go to this one next. So as you can see, this one is in a downtrend. And again, the best way to play this would be if there was a spike like back here and you would play it on the short side, because really on the long side, you got to be pretty fast with your timing. And not only that, if you go to the actual option chain, you will see exactly the same situation with UVXY is with the VIX as well. You can see here, I'm going to go, let's just go to the, something with some decent volume here. You can see here that the implied volatility is in the 80s. So I'm just going out to August 2nd here. You can see if you want to just buy an at-the-money call option, the implied volatility is 81%. Now, this trades a little bit better, by the way. The spread here is 140 by 180, but a $40 spread on a $160, $170 option contract is definitely suboptimal. So just keep that in mind. Your break even again is going to have to be substantially higher. So if the current price is $22.88 and you buy, if you go long this and let's say you pay $1.50 just to keep the math simple, you're looking at let's see, $23.80, about $24.20 or something like that. So going back to the chart, $24.20 you can see is let's see, all the way up around here at this level. So if you to make any money whatsoever, your option is going to have to go somewhere up here and stay up here. And then you're going to have to be able to trade in and out of it. So keep in mind, these products are not that efficient, and they do that on purpose. There is a lot of implied leverage in these, and that's what makes them a little bit tricky. So one of the things you can do to hedge your portfolio is, if the volatility was to spike, you can do some sort of credit trade where you're playing just basically the VIX to melt down, because the VIX does not tend to stay elevated for long periods of time. As you can see, even going way back here, it just tends to melt down over time. So the best way to play these types of products, again, is to wait for that spike and to play the move to the downside, not necessarily to try to catch a falling knife. If this was a stock and you were looking at this, I would imagine you guys wouldn't touch this with a 10-foot pole. So that is kind of, my thoughts on these types of products overall. Just another mental note here on the UVXY. In order to get that leverage, they're doing futures contracts. In order to do futures contracts, they have to continually roll them every couple of weeks. And in order to continually roll them, usually the front month contracts are more expensive than the current contracts or the cash settled contracts that are happening now. So that's basically called contango, and that's a normal state of affairs. Whenever you hear the word contango, or that's just a fancy way of saying that the front month or the futures contracts that go out further are more expensive than the current most recent contract. And in order to catch that leverage, in order for them to get that 2-to-1, they have to go out in time and keep rolling those contracts over. And guess who pays for those contracts? You do, in the form of being an ETF investor. So if you're buying the options on those, or if you go out and go ahead and just buy the ETFs, let's say you're trying to hedge, you're not getting the bang for your buck that you think, especially if you hold this product for more than a couple of weeks or a couple of months. That contango is going to start to catch up to you. So just a thought, just my thoughts on those. So there are more efficient ways to hedge. We do talk about it in our classes. One of the things you could simply do is just do puts on QQQ or puts on SPY, pretty much measure what your overall portfolio risk is, how much you want to hedge and what percentage you want to hedge based on the size of your account, and go ahead and buy put options on SPY or QQQ accordingly. You're not going to get as much of a drastic move, but those will act as pretty decent hedges because they might lag a little bit on your performance if you're, if things are going in the opposite direction. But those hedges will act pretty well in the event volatility spikes and in the event that markets roll over. It's good to have a little bit of a short, especially when things are at all-time highs. It is good to have a little bit of a short exposure. So that is my thing. Like, one of the things I love to do, I talk about all this all the time, is basket trading. And what's great about basket trading is you're pretty much dynamically hedging every single week. What you're basically doing is you're not just going long a whole bunch of stuff, but you're saying, okay, well, what sectors are weak? I want to maybe be long 7 or 8 different option strategies, but I also want to maybe have a couple of short positions on there too. And if you do that dynamically, as markets roll over, your long positions will either get stopped out or you'll probably exit them, and then you could add more short positions as markets deteriorate. So it's kind of like a natural hedge when you do basket trading, and that's one of the things I really love about what I do and what I teach you guys. It kind of dynamically takes care of itself. If the markets roll over quickly, I'm pretty bearish on the NASDAQ now after today. What I'm simply going to do is I'm going to look to short some of these NASDAQ names. Now, some of them are pretty strong. I might not necessarily buy put options on them. I might just do some credit spreads, but I will have bearish exposure in my portfolio. And that's the best way to hedge. These products are great, but like I said, because of the costs, like I showed you with the cost of the bid offer and having to cross the spread, on top of that, the fact that your break even is so high and the implied volatility is so high, they can be a risky bet. So I would look to them more when the VIX really spikes, and you could kind of catch them on the short side, or just try to avoid them altogether. But either way, I wanted to put out this video because I know a lot of you were asking about VIX products and how to trade them. And again, there are ways to do it, but it does require a little bit of time and practice, and they are costly. So just make sure you know what your break even is and you know what your costs are. Those are the keys to trading these successfully. So I hope this video was helpful. Again, if you have any questions, reach out to me in Discord, or you could always attend our live coaching calls on Tuesdays, as well as our game plan meeting. So I will talk to you guys soon. Have a wonderful rest of your week, everybody. Take care.